Hello, everyone. I'm Ted Oakley, managing partner at Oxbow, and I always enjoy having this guest who is not only a guest but a friend of mine, David Rosenberg, who is the founder and president of Rosenberg Research. I think is the five-star economist in the country, and he also invests, which that's hard to find that combination. But David, we're glad to have you today.
Ted, it's a privilege to be back on with you.
Yeah, I just wanted to start off. You've talked a lot about the economy. And I think what you mentioned that if you pull out artificial intelligence, we don't have much of an economy, but maybe you could talk about that.
Well, the proof of the pudding is in the eating. So when you look just at strictly the capital spending segment of the economy, what you see is that AI and related expenditures, because there's been spin-offs, especially in the utilities industry, as an example, um, CapEx, AI, and related in volume terms has expanded at a 17% annual rate so far this year. The rest of CapEx, -3. So, I'm sure we'll be talking a lot about the K-shaped economy and the bifurcation, the polarization in the economy, I guess you can say in society. But you're seeing it actually within the business spending component. You know what's happening? And our good friend Lacey Hunt has been on top of this, is how we're all focused on AI and how transformational it's going to be. We'll see just how transformational it'll be to our pocketbooks down the road. But it is actually draining resources out of the rest of the economy. So, when you lift up your Wall Street Journal or your New York Times or your London Financial Times, and all we read about are all these AI investments, and it's breathtaking. But you never hear about what is the CapEx spending project in the other segment of the business sector, and it's because it doesn't exist. It's actually contracting. And there's another element to this. So actually, massive bifurcation between AI and non-AI CapEx. But what's holding the glue together on the consumer side is what AI and 10 mega cap stocks. We have a situation where 40% of the stock market are these 10 mega cap $1 trillion stocks. I think all 10 stocks now are like $1 trillion companies. I think at the peak of the bubble in March 2000, the largest company was Microsoft, and its market cap was like $500 billion. So in any event, it's driven the stock market up, maybe a little wobbly recently, but there's something that is called the equity wealth effect on spending, which, when I went to economics school back in the 1980s, we all knew that existed. There's different things that drive consumption and obviously employment, income, but there's a wealth effect, which all Ben Bernanke talked about with his repeated quantitative easings was the need to get an equity wealth effect on spending. And boy, that did actually work out after his multiple rounds of balance sheet expansion. So what's happened is that the savings rates come way down, and we have this. When we talk about bifurcation, people say to me, "Where's this recession?" Because consumer spending since April, in volume terms, is up at call it a 2.2% annual rate. Actually, it's up 2.6%. But real disposable income is -1.2. This $18 trillion chunk of the economy called real PDI, disposable income, is actually in a recession. But just like the market multiple in the stock market, the PE is a behavioral aggregate. The savings rate is a behavioral aggregate in the economy. So you can actually have, believe it or not, negative real income growth, and that's what's happened with inflation stubborn at 3% and the labor market cooling off and wages moderating. You get negative real disposable income, but rising consumer spending. But because we're all so narcissistic, we always measure economic success on the spending side. I know that you and I don't, but when you look at the income side of the ledger, and you look at personal income, which is a dominant force of domestic income, that's in a recession. But because nobody looks at it, it's obviously isn't relevant. But what it means is that if and when the stock market stops going up and the savings rate, God forbid, pulls a Bob Farrell rule number one, mean reversion, and you get consumer spending growth converging on real incomes, that's when the recession is going to hit home. Hasn't happened yet, but that could well be the 2026 story.
In your career, have you ever seen a time like this where the stock market was the economy?
To this extent, just one other time, and it was in the last tech bubble in the late 1990s. Except I would say that the economy overall was more vibrant back then. Let's keep in mind that, in the past week, we got the final number on the University of Michigan Consumer Sentiment Index. And in November, it was at its second lowest level on record. What I don't think we've ever seen a disconnect. What's fascinating is that when you look at the component in the University of Michigan Index that assesses bullish views on the stock market, it's still in the top half of all the readings historically. But yet confidence in the economy and in the labor market and on labor income is that it's the lowest 1% readings of all time. That I could tell you, that dichotomy I've never seen before.
Yeah. Let me ask you, switching just for a minute or two, where are you on housing? Where do you think, everybody keeps thinking something's going to change, but nothing really ever changes. But how do you feel about it?
Well, I always say that the truth is in the price, so long as it's not being manipulated. So the truth should always be in the price. And, we just got, the FHFA house price data, the Case-Shiller house price data. The trend in home prices is going down. In fact, in real terms, home prices are actually deflating. And so when you look at the price movement of anything, if it's going down, it means we have a deficiency of demand relative to supply. We hear all the time about how there is not enough supply, not enough supply. Well, actually, if the price is going down, it means we do not have enough demand relative to the supply that's out there. So we have we have an affordability crisis across many goods and services that pertains to housing, because when you look at the affordability index, it's still something like stretched 20% beyond the historical norm. And that's the bit of the problem here, is that even as the Fed has been cutting rates, yields out the curve have, although they've come down in the past couple of weeks, they've been more or less range bound. But you see, everybody is saying the Fed's got to cut rates, Fed's got to cut rates, Fed's got to cut rates. We're debating December the 10th. But you know what happens on December the 10th if they do what they did last year? Not once, but twice, where they cut rates, and then either through the dot plots or their guidance, they say we're done. So what they give you at the overnight rate, they take away in the bond market. But you see, if you're a business person or a consumer, you're borrowing rates that's priced off the bond curve. The only people that borrow in the overnight rate market are the banks between themselves. So the Fed shoots itself in the foot to some extent. Of course, we've got this wide divergence. I think that what do we need? We need, the 50-year mortgage to me is a ridiculous concept and a sign of desperation. What we need, and this is the one area I will agree with the president, is we need much lower rates. And if it means that to get the whole yield curve down, the Fed has to do even more at the front end, then they'll have to cut rates that much more aggressively. Again, though, we have a problem here where we have a situation where the credit sensitive sectors, and it's not just housing, but it's autos. And look, in the old days, when I started in the business, you looked at housing and autos, you'd be saying we're in a recession already. But of course, services have taken up a bigger share of the economy. But you asked me about the housing market. I think that it needs lower financing costs to help improve affordability. I think at the same time, you know what they say, right? That the best cure for high prices is high prices. So, it's a tricky situation because when you think about mean reverting the affordability ratio, it's three variables, right? The denominator is income, and then you got your interest and principal payments. So you got basically three variables: income, home prices, and interest rates. So how are we going to mean revert the affordability ratio to get demand off the floor? Because the problem is not really supply. If you're taking a look at supply, the supply of available homes in the market has gone up in the past year. But what has not gone up are home sales. It's because demand is flat on its back, if not contracting.
And we forget
And
about we
so
forget we forget about insurance. I mean, insurance today for young people and taxes. I'm not sure it's as much as the price it is the interest rate, because you look at the insurance on top of that, and that it just chokes the whole thing down.
well, the homeowner insurance, and that comes down to, of course, what's happening. Well, uh, weather disasters and environmental situation. Insurance is actually, when I talked before about inflation, there is inflation in insurance premiums across the board. I mean, not just property and casualty, but also life and health. So the property insurance is a big deal. There's no doubt about that. Utilities. I mean, people talk about AI being deflationary because of productivity, but that has to get amortized over a long period of time. The productivity is not evident right now. But what's evident right now is the pressures it's putting on the power grid. So yeah, you're 100% right. You've got these. We're promoting this AI boom, and it's creating stresses in other parts of the economy. One of them is the utility sector, and those prices are going up sharply. You mentioned insurance. I don't know what the answers are to that. What I'm saying is that to cure the affordability problem, we either need to have an income boom. We need to have an income boom. It's I guess it's hard to do that when you have negative immigration policy to get that aggregate income boom. The labor market right now is loosening. That's putting downward pressure on nominal wages. It'd be nice to actually redress the housing problem by redressing a more fundamental problem, which is income growth, especially for the bottom 50%. On top of that, the Fed should be cutting rates. I think that they are once burned, twice shy because they missed transitory. So they're still fighting last year's battle. It's the one area I will agree with Donald Trump on. I don't think I would deploy his aggressive methods on openly insulting Jay Powell. But I think rates have to come down. Home prices also have to come down. And you see, but home prices coming down, I don't remember a time when a negative residential real estate cycle ended up very good, because it is, after all, for the homeowner class, a $50 trillion asset class on our balance sheets. So, there's an equity wealth effect on spending, but there's also a housing wealth effect on spending. So it's a complicated situation. The key for me is waiting for what will drive affordability. I think that the Fed should be taking this more seriously. It's hard for me to believe, looking at the fact that rents are deflating, and look at the fact that home prices are either deflating or rapidly disinflating, that we really have an inflation problem on our hands. And I look at the insurance situation, Ted, as a tax on the household. It's not really a demand. This is a supply. And if the labor market is loosening up, as it is, there's a snowball's chance in hell that these insurance costs get passed into wages. Same with tariffs. What the Fed should always be worried about with these shocks is, will it get transmitted into wages and create persistent inflation? And that's what happened in 2022 and 2023, is that the labor market out of the blue started to tighten, and all of a sudden the supply chain squeezes, and the cost increases got transmitted into the labor market quite unexpectedly. I don't think you can make a base case for that this time around. So they should. So, but the bottom line, simply put, the Fed should cut rates, and they should signal that they're not going to stop before they get below their 3% neutral. But you see, they shoot themselves in the foot because every time they cut rates, you got Powell up at the podium sounding hawkish. You got these other Fed people sounding hawkish, and then their dot plots are hawkish. So, why bother even cutting rates at the short end if you're going to shoot yourself in the foot at the longer end of the curve where interest rates for the average Joe and Jane are priced off of? So what they have to do, in my opinion, is improve their guidance and get the whole yield curve down. And that's how you get mortgage rates down. By the way, that would be a start.
I think in the past week, you listed what you thought the Fed governors would vote on December. And I think was it a toss-up or was it a
Very close,
close?
but just modestly in favor of the Doves.
Yeah. Okay. Uh, Moving on from that, as I know, uh, you're one of the few people that own as many treasuries as we do. I'm going to tell you, I rarely meet anybody that has as large a treasury allocation as we do, but you do. So I'm assuming you're still high on the bonds themselves.
Yeah, it's one of our high conviction calls for the coming year. And I'll tell you why. I think that the Fed will end up taking the funds rate not just to the 3% neutral sometime this winter, but we'll be on our way down to, I think, 2 to 2.5% by the end of next year, which is way out of consensus. But here's my reasoning. My reasoning is this, that being a Canadian out of Toronto, what I can tell you is that in Canada, 90% of everything is correlated with the United States. We are the 51st state, and everything is correlated in the markets and in the economy. And there are times when the U.S. leads Canada, and there are times when Canada leads the U.S. I mean, we're a bigger economy than California. We're not insignificant. And where is the Bank of Canada's policy rate right now? Because they've chosen to get ahead of the curve. The Fed's chosen to stay behind the curve. The Bank of Canada is at 2.25%. I mean, the Fed is still close to 4. And historically, there is a 90% correlation between the central bank policy rate in the two countries. So, I mean, you tell me, in the next year, is the Bank of Canada going to tighten policy with a 1% growth economy? Is the convergence going to come from the Bank of Canada taking rates to where they are in the US? Or will the Fed take the funds rate in the line to where it is in Canada? The only difference is that has been time. Those two policy rates historically stay on top of each other. So we have a very wide dichotomy here. I think the Bank of Canada is ahead of the curve. The Fed's way behind the curve. But you do the yield curve analytics, Ted, and you go down to roughly 2.25%. The 10-year note is going from 4 down to 3.25. And then when I tell clients that if this forecast is prescient, and you look at the total return, you add on the capital gain to the coupon. When I tell people, Ted, that believe it or not, you'll be able to make 10% in the treasury market in 2026. You know what the response is back to me? Do you know what people say to me? They say, that's it?
Yeah. That's probably right. I was going to say your duration is about, it's like 0 to 10 years. It's not like super long.
No, we don't. In our rosy macro fund, we have a twos tens barbell because we find the twos will be a good place to be because they're most sensitive to the Fed. The long bond is I would like to have 30 years, but I just find that that there's going to be this, we're going to elongated period where the long bond may be the little orphan Annie that'll sort of hang out there. I don't think it's going to hurt you. I just don't know. I think the yield curve is going to steepen a lot out to the 30 years, and it's probably because, mostly because of the fiscal risk premium that has the biggest impact at the very long end of the curve. I don't mind if I'm proven wrong, because if I'm proven wrong, well, I'll do fine in the tens, which for me is just a little, the risk reward profile at the 10-year part of the curve is just more appealing to me.
Yeah. Well, you had a good year this year. I'm going to switch on you to the stock market, and I have a couple of great, of course, you have the best graphs, I really think, of anybody in the business. I will say that, and we're going to show something again. And by the way, if somebody wants to take a trial of your all your research, I think you're doing a 2-week free trial, but we'll have that URL at the end. But I want to ask you on the market, I've got a graph here of the CAPE ratio, and talk a little bit about that, because this goes all the way back to like 1920, I think.
Yeah. Yeah, it's actually my preferred valuation metric because it smooths over the cycles. It has a rich history. But frankly, you could look at price to book, price to sales, price to earnings, and they're all basically between 2 and 3 standard deviation events. And I only invest in 2 sigma events on the cheap side, like how you want to buy the stock market at a negative 2 SD in August of 82, and in March of 2003, and again in March of 2009. We're in the opposite ends of the spectrum. And that's the thing here about our business, Ted, is that we can talk all we want about the fundamentals, but we have, and that AI has not changed this, right? Technology has not changed the fact that we are humans and we are governed by human nature and the extreme emotions of fear and greed. It was our friend Bob Farrell back in the 50s at Merrill who introduced sentiment in his work. So that's what the multiple is. The multiple is the heartbeat of sentiment. And what people don't realize is that when we talk about the fundamentals, is that the multiple is even more powerful. In a bull market, when you look at that chart, you look at the multiple. In a bull market, the multiple expansion is 40% of your return. In a bear market, it's the multiple contraction that accounts for 80% of your disaster. In the bear market, the multiple takes over. So we get earnings recessions. But the reason why the stock market typically goes down even more is because you get the multiple contraction as fear replaces greed. So yeah, so what's the CAPE multiple, Ted, is flirting with 40. So you look at the chart, it's only been here before once, and that was in the late 1990s. And it was actually, but the question is, when did it become a 2 standard deviation event? Was in June of last year. Like we have been, that's when I had Jeremy Grantham on my call, and I said to him, people always say that it's a fuzzy concept, a bubble. He says, no, it's not. It is actually when anything gets above a 2 sigma event. Well, this happened in June of 2024, but you see, and this goes again back to Bob Farrell's famous market rules to remember, that bubbles go further than you think, but they don't correct by going sideways. But let's take the first part of that refrain. They go further than you think. And yes, you can make money in a bubble, but understand, that you're basically in a baseball game that's gone into extra innings, and that's where we are. Actually, it's interesting that the median length of time from the start of the bubble to the peak in the market is 16 months, which would mean that if October 28th was the peak in the S&P 500, it'll be perfect as far as what the median performance has been in the context of a bubble. And in a bubble, by the way, the time you cross 2 sigmas to the peak in that 16-month period, the S&P is up historically 25%. This time around, it's been 27%. I mean, you can't believe how perfect it is this time around. So the CAPE is very important in that respect because again, it's not the only valuation metric, but as you said, it has the richest history, and it's not a timing device. It's not a timing device. I mean, people always say, the bulls always say, well, you can't, valuations are, it's not a timing device. It's basically at any point along the valuation curve, the PE curve, the CAPE curve, the Buffett indicator curve. The higher you go, the more you've gobbled up your future expected return. So the multiples are important because they tell you at any point in time, do you have a tailwind or a headwind? Is the wind at your back or in your face? And it's in your face right now. Look, never mind, that we crossed, two sigmas back in the summer of last year, but we're at a 40 multiple. And when you're north of 35, which we've been in over the course of the past, call it 4 months, we're pressing against 40 right now. But we notice that when you're taking a look at the CAPE multiple and you slice it into ranges, 0 to 10, 10 to 20, 20 to 30, 30, 35, 35 plus. 35 plus as the starting point of that multiple. That's the only part of the CAPE, 35 plus on that multiple, where the 1 year, 3 year, 5 year, and 10-year returns are all negative. So if you're blindly, and by the way, I'm not saying that I'm bearish in every part of the stock market, but if you're buying the index, you are relegating your clients to a future of negative returns in the next 12 months and beyond. So I'm waiting for those valuations to normalize and mean revert. And I have the liquidity to buy things at better prices. And it's not as if we haven't seen this play out before. What's fascinating is that nobody believes we're in a bubble. It's incredible. The pushback I get reminds me of all my days at Merrill on the housing and credit side. There's no bubble. I was actually told by my managers not to use the word bubble anymore. I said, well, can I use mania? They said, yeah, but you can't use bubble. It's too emotional and it's making people scared. So you can't use the word bubble. But we've had bubbles in the past. And what's interesting is that at the peak in the bubble, the masses always will tell you that this is different this time. Okay,
Well, we have a
we'll see.
graph too. There's two things I wanted to discuss with you. You have a really good graph, and you have 3 or 4 great graphs in this area, but I'm going to use this one where American households have $50 trillion of equity stock market exposure. And I would guess that a lot of that is in the index, who knows? But you also have, always had a circular pie graph that shows something like 70 something percent in stocks. But talk a little bit about that because I don't think people realize what the risk of that is.
Well, we have concentration risk layered on top of concentration risk to a degree that we've never seen before. So, for example, I said before that the top 10 stocks in the S&P 500, measured by market cap, is over 40% of the index. Even at the tech bubble peak in March 2000, the share of the top 10 in the S&P was less than 30%. The concentration risk is unprecedented. And what makes me more nervous is what you said before, is that over half the stock market now is passive index investing. So people don't even know what it is they own. They have no idea. They don't have an advisor anymore telling them, you got to move 10% into cash, or in the old days, we used to call them brokers. Nobody wants to be called a broker anymore. But they would say, hey, we're going to buy Ford, sell GM. We're going to sell Cisco, buy Microsoft. So they're making decisions for you. Active management has gone the way of the dodo bird. But you see, because the active manager, the thing is that active managers get paid to manage the risk for you. Index investing does not manage the risk for you. And so because the active managers want to stay in business, they're playing the game right now. Do you know that the cash ratio for active managers in the equity market is down to 1%? there's razor thin liquidity. If we get a cycle of redemptions, there's going to be forced sales. But they've been forced to play the game. We've never seen that before. A 1.2% liquidity ratio for active portfolio managers. There's no margin for error. So then we have everybody is all in at the same time. Now you mentioned the 72%. That's unprecedented. 72% of the household asset mix is in equities, and only 8% is in bonds. But what are you going to do? Like seriously, when you go to your neighbor's cocktail party, are you going to talk about your treasury portfolio? Like, Ted, don't you want to make friends? I mean, you're going to put people to sleep. But that's why, look, I'm a contrarian at heart, and I like to buy assets that are under-owned. 72% equity exposure, unprecedented. Only 8% are in bonds because, of course, as you and I both know, bonds are for losers, right? There's no sense of maybe this is a diversifying ballast in my portfolio, a risk mitigator. But the words diversification and risk mitigation, Ted, they've been thrown out in the waste paper basket, just like the Dodd and Graham's security analysis book from the early 30s have been thrown out in the waste paper basket in this cycle. But I'll tell you right now, what makes this different is the demographics. We have a situation where I said before, 72% of household financial assets are in equities. Nobody's rebalanced. Nobody's taking chips off the table, and everybody thinks they're going to be able to time the exit. Now, don't forget, I have 2,400 clients in 40 countries. Half are institutions, half are regular people. And the regular people, I'm telling you, they all think the institutions are more sophisticated. Okay, like you. Okay, not everybody is Ted Oakley. But I have a lot of clients that are like what you call, quotes, retail individual investors, and good grief, the bravado, because they think that they're smart as opposed to lucky, as opposed in terms of what's happened this cycle, but they'll all time the exit. But I'm nervous about the demographics, okay, because over 60% of the baby boomer portfolio is in equities. And you look at the life cycle of investing, it should be 30 to 40%. They're over 60, the boomers. But the boomers, the median age of the boomer is 70. The first of the boomers are 80. They're the median boomer, the 80 million plus pig in the python that's driven everything in the past 8 decades, from the economy to the markets to politics. Okay, they basically have way too much risk on their balance sheet, and they don't seem to care. And so this is actually, so we're going to stress test. We're going to stress test because the markets move in cycles. Whether people want to hear it or not, they don't like to hear this, but markets move in cycles. Bull markets and bear markets. Bull markets, thankfully, are long and strong, but bear markets might be short and brief, but they are escalators going down. You get your head sliced off. And so I'm a little nervous because we're going to stress test the fact that for the first time ever, you see in the dot-com bubble burst, the median age for our group, because we're both boomers, was 45. Time was on our hands, Ted. Time is not on our hands right now. And so all these people, if you want to look at a bull market chart, draw yourself the chart of people who've left the labor market, 55 and over, because I don't have to work. I got the pot of gold at the end of the rainbow called the S&P 500. So what's going to happen is that these people are going to realize, oops, I do not have the pot of gold to fund my retirement lifestyle, and I'm going to live longer. And then they're going to go off to the local Walmart to find a job at the checkout counter, only to find that a robot's taken that over. So we're going to, so by the way, that's, when I think about that, and I think about the deflationary consequences from that, fiscal or no fiscal, it makes me go back and start to think maybe I should start adding some to the long bond exposure after all.
Well, David, we see people that are 70 or 80 that have 75% of their portfolio in stocks. Now, a lot of them are do-it-yourselfers. So they've had these 15 years here, and they think, this is very, very easy to do. And why would I listen to somebody like Ted Oakley or David Rosenberg when all I've had to do is plug in and wait out? They don't last very long, but I have to agree with you. I think that's probably one of the biggest problems that we'll face. Because if you think about it, David, if you're 75 years old and you lose half your net worth, think about it. You've got children too, and they're like, okay, you can get sick. There's a lot of things that go on there. I don't think
Yeah.
people factor it in.
You never, I mean, I've written about it, you've written about it. Nobody talks about the demographics and how that's going to make the bear market. Because the bear market will come and then a bull market will come. But I'm not going to, we're much closer to the bear market than anything else. And so the demographic part of this is I think it's going to make things worse for the economy. That's my sense, and that's when people say to me, "What keeps you up at night?" Well, because I take 10 milligrams of melatonin. I've solved that already. But what keeps me up is my concern about the complacency, generally speaking, but also the fact that the most mismatched group of society are the aging and getting to be aged baby boomer class.
Yeah. And there were a lot of do-it-yourselfers at the end of the late 90s, and early 2000. But I actually think there are more of them now. Because we get comments back from them like, "Hey, you guys don't know what you're talking about." You probably do too.
Well, look, I gave a speech at a banking conference 2 weeks ago, and as I finished my speech and I'm standing at the bar having a gin and tonic, and people are talking to me on the way out, and so when the crowd sort of trickled out and I was on my second gin and tonic, the bartender says, "Excuse me, Mr. Rosenberg." I said, "Oh, by the way, only my kids call me Mr. Rosenberg. They call me Mr. Rosenberg. Sure, you can call me Dave." He says, "Dave," he says, "this is what and this is 100% true. I have witnesses." You know what he says to me? "Should I be buying Netflix here?"
Yes, that is
I
so
said, "Are
true.
you also an Uber driver?"
Yeah. So, Trey, I'm going to give you one last question. If you were talking to the average 50 to 60-year-old investor today, young people are different, they got a lot of time, but the average investor 50 to 60 today, what would you be your advice to that person?
Well, it would depend on how they're positioned right now, but I would have for the time we're in right now and understanding where we are in the cycle, I would have a low beta, high Sharpe ratio, low risk portfolio. Um, I would not be owning the S&P 500, that's for sure, or the Nasdaq. I could tell you that I would be low equity weight exposure, higher than normal bond weight exposure. I'd want to make sure that I have cash, which is at least paying you something, because you want to have this one thing, liquidity. But you have to have, look, your assumptions in this business drive your conclusions. My assumptions are that we are at peak market. The wobbly nature that we've seen in the past several weeks, very consistent with what we saw actually heading into February, March of 2000. I'm seeing all those signs. You want to have liquidity on hands. Now, look, if you don't want to part with your portfolio, because of course, I always tell people fall in love with your partner, not your portfolio. Your portfolio won't love you back. But if you fall in love with your portfolio, I'd say take some insurance out, like sell some call options against your portfolio. Um, so be a little more defensively minded and invest around the part of the cycle that we're in. And I'll tell you that I found that in the post-bubble experience, what you want to do is engage in some long short strategies, some pair trades. Like I'll give you an example. If you look historically, after the bubble bursts, or just say after a bull market ends, what does really well, and especially now because what's going to have to mean revert is this intense concentration in the S&P. You go long the S&P 500 equal weight, you go short against that, you go short the market cap, the cap weight index. You go long the S&P 600 and go short the junkier Russell 2000 and the small cap. So you want to play quality, but actually we find that a lot of these pair trades going long in the currency market, for example, going long the Swiss franc against the Australian dollar is a home run. So there's a lot of creative ways based on relative value or pair trades that you can actually make some good money as the tide rolls out. So those are some of the ideas that I have. But certainly, if you have a traditional asset mix, if you haven't rebalanced already, you want to get the equity weightings down, or at least be in the sectors that are most defensive and pay you a yield. Probably, I'll tell you this much, something for people to contemplate if we get the Supreme Court decision in December. And the Supreme Court, I'm talking about on tariffs, because the Supreme Court is really busy these days. But if they rule against Trump and they find it in favor of the two lower courts, and these tariffs are deemed to be illegal, and of course the White House will be scrambling for other valves, but you're going to find a very nice trade in the consumer staples. Because I think they're the only S&P sector that's down for the year. Their margins have been seriously crimped because of the tariffs. These tariffs come off, that'll be the one area, the one sector that I think will have probably going to next year the greatest outperformance opportunity will be that part of the market. Plus the fact that it's purely defensive and usually outperforms in a recession anyways, assuming that we get one. We have one on the income side, just not the spending side, but we'll see if the spending follows the income in 2026. I think that'll be the big story.
Well, listen, David, as always, you're always great to talk to us every year, and we also will show a little URL where they can take a 14-day trial if you want to. I would tell people you write every day, and it's excellent in what you do. But we'll thank you again, and hope you have a happy Thanksgiving.
Thanks, Ted. Great seeing you again.
All right, thanks. Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.